an aircraft leasing company. We've been coming to Master Investor now for a number of years. And then pre-COVID, the company had a very strong history of growth, rising share price, even a good dividend. Now, COVID created a number of serious challenges for the company. And for the past 2 years, we've been working to mitigate and solve those problems and preserve liquidity in the business and maintain the business. And we feel that we've weathered the storm, and our recent results released 2 weeks ago suggest a turnaround in the performance of the company, which is why it's exciting to be here and tell this story. Now, if you believe that the worst of COVID is behind us, as I do, then there is a tremendous opportunity for investors to invest in a proven business model, proven management team, and a historic success story, as Avation shares are yet to have any bounce back, and in fact have taken another hit as a result of the recent tragic events in the Ukraine. Even though we have no exposure to Russia and no exposure to Ukraine with any of our aircraft. Avation shares are currently trading at the largest discount to NAV per share in the history of the company. Less than 2 weeks ago, we announced our 31 December results, and that saw a turnaround from the 30 June results that felt the full significant impact of COVID. The financial results ended 31 December 2021 reflect the emergence of the company from the severe disruption created by COVID. Revenue exceeded expectations, and Avation's strategy to conserve liquidity and to maintain our cash has succeeded, with net indebtedness at the same time being reduced as cash collection rates from our customers and unrestricted cash balances improved. We expect this trend to continue through to the 30th of June, so there's a lot of positive directional trend. We had significant impairments and provisions for credit losses on receivables experienced to 30 June. Some of these provisions may actually be written back as we collect the tens of millions of dollars owed to us by airlines. Impairments that were recorded are simply related to off-lease aircraft, which included some of the ex-Virgin ATR aircraft that we had, 3 of which we've recently announced we're selling. So the numbers of unutilised aircraft that we had are going down and reducing even further. The fleet is returning to high levels of utilisation as unutilised aircraft continue to be repositioned or sold. The significant impacts of airline insolvencies or restructuring of some of Avation's customers have all been reflected in the previous results to 30 June. We're now engaged in a review of different alternatives and are now looking to start growing the company and adding new customers into the fleet. We're seeing an increasing number of positive data points, almost on a weekly basis, that support our optimism in the future of the aircraft leasing sector. We're seeing increased interest from airlines to buy or lease aircraft at sustainable lease rates, more senior lenders willing to lend against aircraft assets. Aircraft orders from airlines are starting to improve. And obviously our customers are using their planes more than at any time in the past 2 years. These factors also all support the emergence of our industry from the grips of the pandemic. Now, what we are doing is cautiously positioning ourselves for a return to growth through opportunistic aircraft trading and deliveries from our order book in a post-pandemic environment. And I'll just repeat again, because I've been asked about 20 times today, we have no exposure to Russia or Ukraine. It's a quick legal notice there, and I'll go on to a quick snapshot of where we are today. Now, the last 2 years since the declaration of the pandemic have clearly been the most challenging in the company's history. It impacted our cash flow, it impacted our customers, it impacted the valuation of our assets. As at 31 December though, we had 42 aircraft in the fleet. We still had 16 customers in 13 different countries, and we own mainly regional and narrow-body aircraft and have a couple of wide-body aircraft. The fleet is split 17% wide-body, 50% narrow-body and 33% regional turboprop aircraft. It's a very young fleet at 5.3 years old, with 6.1 years remaining on leases. So today the fleet's worth about $1 billion, and we have, with that fleet of 42 aircraft, contracted revenue we'll collect over the next 6 years of those leases of $575 million plus a further $64 million in finance lease receivables. That's over $100 million a year in revenue, which is exactly what we're going to generate in revenue this year. So we've come out of the pandemic, the worst black swan event in the history of aviation, and we still have $1 billion of assets and are generating $100 million a year of revenue. We've got we have less than 20 people working for the company, and we've kept everybody working for the company because we knew there'd be an opportunity to bounce back post-COVID. And we've signalled that desire to return to adding new aircraft into the fleet, adding new customers into the fleet, ordering from our order book, and opportunistic purchases. Here's some more detail on the fleet. We're focused on fuel-efficient aircraft that service regional and narrow-body aircraft. It's these sectors that are seeing the fastest return to pre-pandemic levels of travel. 83% of our fleet, in fact, is focused on regional and domestic travel, which even towards the end of 2021 was very close to returning to the levels of travel in 2019 pre-pandemic. We like new aircraft, we like to put them on long leases. Generates revenue, it helps pay the aircraft off. In the last year, we rescheduled our order book because there was no real need to grow in the last couple of years. But those 28 orders, those 28 purchase rights and 2 orders that we have provide a visible pathway to growth. And those aircraft are worth about $600 million. So that's $600 million of aircraft we can add to the $1 billion of aircraft that we have now, on top of other purchases that we can make. Here's some detail, some granular detail on the 16 customers that we have, which include 5 flag carriers. This is very important. Flag carriers were not excluded from the impacts of COVID and the travel restrictions that these airlines face, but they did receive a lot of government support. And in addition to that, it's these flag carriers that fly the most regional and domestic routes. So they've been able to bounce back to pre-COVID travel levels. And what we need is our customers flying so they can generate revenue, so they can pay us rent. And that's exactly what's happening with these customers. So we've been able to conserve a majority of our customers. Our team of people are still in place. The majority of the fleet is still in place. The business model we know works in a pre- and post-COVID environment, and that's why we believe our business is largely intact. We've got a list of our customers there and the aircraft that they have. We have recently announced that we're selling, what we've been trying to do is we've had unutilised aircraft on the ground not generating rent, and that's the worst thing a business can do for us. We recently announced the sale of 3 ATRs to Aegean Airlines. We've delivered one of those planes already. We'll deliver another 2 by 30 June. That's tens of millions of dollars of cash coming into the tin. In addition to that, less than 2 weeks ago, we announced that we'd signed agreements to sell 2 ex-Logan aircraft ATRs, and that we'd placed one of the old Virgin, ex-Virgin Australia ATRs to a new customer. This means that we have just only 3 unutilised aircraft, and we expect to reduce that even further by 30 June, getting back to 0 unutilised aircraft and returning Avation to the type of efficiency we had pre-COVID. The worst thing a business can do, that we can do, is have aircraft on the ground not generating rent. And that has been a feature of this company for the past 2 years. Since the start of the pandemic, Avation has had 20 aircraft returned to us by airlines in trouble, including the 13 that we got back from our biggest customer, Virgin Australia. The completion of those transactions that I just mentioned will have sold or repositioned 17 of those 20 aircraft. Now that's a fantastic achievement in what is the toughest market. It's unwanted achievement, but we've had to do it. And that's why we think that we're now getting back to the levels of efficiency that we had pre-pandemic. The last couple of aircraft that we've got are a couple of ATRs and an ex-Garuda 737. And we have interest in these planes. So we expect to reduce those unutilised aircraft even further. I'll just touch quickly on some financial results. I won't go into too much detail because all the detail is on our website. There's a video of a webcast on our website as well. These results were released on the 3rd of March. But during the period, 6 months, we generated over $60 million in revenue. And that was down 5% year on year, but it did exceed expectations. Operating profit totaled $18.8 million, which is a huge turnaround from the $34 million loss that we made in the same period in 2021. And this resulted in a tax loss of $15.3 million, but that was a sharp drop from the $61 million that we lost in the corresponding period last year. And most of that $15 million loss was due to non-cash impairments, non-cash items and impairments that we don't expect to recur again. And to put this in context, the disruption caused by the pandemic last year to 30 June resulted in over $100 million of impairments and credit losses. Now this simply hasn't repeated. It means that we are emerging from the pandemic. It means that we are returning to normal state of business. Fleet assets have declined slightly to $1 billion. Weighted average cost of debt remained the same. And most importantly, and this is probably your most important takeaway from my speech today, our NAV per share remained the same at £1.64 because the P&L losses recorded for the period were offset by gains elsewhere on the balance sheet. Today, the shares are trading at, I think on Friday, at 82p, which is half the NAV per share. That is the biggest discount to NAV per share in the history of the company. Prior to COVID, we were always trading around NAV per share. I think once investors realise that we are back, that people are getting on planes again, you can travel again, the world is opening up, there'd be a great opportunity for them to look at what is a fundamentally undervalued company. Here's some quick highlights of what we've done in the last sort of 6 months. We've sold a couple of aircraft, we've leased a few aircraft, we've extended leases on aircraft. And so we have been active all through the COVID period. I won't spend too much time on this because people do ask me, you know, what was the impact on the balance sheet of COVID? Well, our net indebtedness has come down $70 million in the past 6 months. We haven't blown out the debt. We haven't blown out our leverage. And so we've managed to, while we've shrunk the company a little bit, we have paid down debt and we haven't blown out our costs. That gives us a very good footing to restart the company and restart growth and start returning the company to revenue growth. Revenue growth will lead to profitability, and that has always in our 15-year history led to share price growth. So a little bit about liquidity, because people said, well, what's going to happen if your airlines aren't paying your rent? Well, we had a really strong focus on maintaining liquidity, preserving our cash. And in fact, we were able to do that. You see that the cash hasn't changed in the past 6 months, but the unrestricted cash has actually gone up by 25%. The company has grown its number of unencumbered aircraft, and cash collections are now returning to pre-COVID levels. Our cash collections year to date to 31 December were 91% of pre-COVID levels, and the cash that we collected in the month of December alone was 171% of what we would normally collect in December. And that's because the airlines that owe us tens of millions of dollars are starting to pay it all back. So we are now expecting a number of positive cash inflows over and above normal cash operations in the next few months before 30 June. These include those 5 aircraft that I mentioned that we're selling. That'll bring in tens of millions of dollars of cash. Collections of those debtors from those customers that owe us tens of millions of dollars. We've had airlines that have gone bust. Virgin Australia, the liquidator owes us millions of dollars from that. We've had Philippine Airlines restructure, which was only completed 31 December, and they owe us millions of dollars. So we started collecting that money, and a lot of that money's coming in over the next sort of 4, 5, 6 months. Cash in the tin is king. Cash is what enables us to buy more aircraft, and cash is what enables us also to de-lever the balance sheet and pay off our most expensive debt. We've been paying off debt, but this extra cash in the tin gives us the ability not only to return to growth, but to help lower debt amounts, and that also helps lower our cost of debt. It improves our profitability. It'll return us to making profits all the much faster. So what we did during the last 2 years of COVID is that we allowed our airline customers to defer some of their rent. It wasn't a rent decrease, it wasn't a rent holiday. They owe us that money and they're now paying us that money back. And what we did to survive that is we talked to all our banks and we said we have to adjust our amortisation schedules on the loans, and they all agreed. They all gave us the support that we needed, and that's why we come out of COVID with about the same amount of cash in the bank that we had at the start of COVID. We were being ultra conservative, we didn't grow, we preserved our cash, preserved our liquidity, we paid off some debt, and now we can return to being the Avation that we were pre-COVID. Now that was a company that in December 2019 was £3.40. We're 82p today. And yet we've still got $1 billion in assets. We've still got $100 million a year in revenue. So when is our share price going to go up? Well, I don't know, but I can tell you some buying signals. We've got those 5 aircraft sales that we're going to expect to complete by 30 June. We'll release stock exchange announcements. You'll see that happen. We're collecting money from our debtors. You'll see that happen. We've got those 3 unutilised aircraft, which we expect to reduce even further by 30 June. We're seeing, you can look up data from IATA, which represents all the airlines around the world, and you'll see that customers are flying more and more each month, more and more each week in fact. And so that if people are flying, then airlines need aircraft, airlines are generating revenue, they need more planes, lease rates will go up, and that's what makes our business work. And what we hope to show you as well in the next short term is a return to growth by adding new customers, new airplanes into the fleet. And you'll also see us hopefully paying off some of our most expensive debt. Now you'll also know anecdotally yourselves, the UK has led the world in opening up, returning to normal. The US has done the same. Asia is a little bit slower, Australia is a little bit slower. You know that the impacts of the tragic invasion of Ukraine cut our share price by 20p. But we don't have any exposure to Ukraine. But we get caught up with all of the other guys who have 500 planes in Russia. But we don't have that. So you are seeing the result of vaccinations. You are seeing companies open up. You are seeing people buy tickets. This is all the signals you need to suggest that our industry, our sector is returning and that it is investable once again. So just to summarise and just to conclude, the disruption created by the pandemic is beginning to recede following the successful rollout of global vaccination programs, and we are seeing a return to increased levels of air travel. The trend is already evidenced in regional and domestic travel, which is where we have most of our planes, and we expect this to be followed by international travel throughout the rest of the year and into 2023. The situation in Ukraine hasn't had any impact on our customers, but is a fast-moving and evolving situation, of course. We don't have any exposure there. The fundamentals of our business and our business model remain intact, and the recent completion of Philippine Airlines restructuring on 31 December, and they had our biggest plane, and as a result of that restructuring, they're keeping our biggest plane and they're paying us millions of dollars of rent on it. So that was one of the last shadows of the pandemic that overhung our fleet. And so now we're moving onwards and we're moving forwards. Our fleet is a little bit smaller, but we have barely anything sitting on the ground. As I said, cash flow for the remainder of the financial year will be boosted by aircraft sales, collections of debtors, collections from insolvents, from liquidations and things like that. And you'll see the cash balances go up. So we're going to right-size the fleet, we're going to collect that money, and what we want to do is return to revenue growth, profitability, and that's what always drove our share price. There are going to be great opportunities for us to buy aircraft from airlines, from other lessors. Those lessors that are impacted by Ukraine are selling good stuff now because they need the cash. So we're optimistic about the long-term opportunity for airline travel, we're optimistic about our business model, and we're optimistic about turboprops and narrowbodies, which we focus on. As a management team, we continue to support, we continue to be shareholders, and so we're aligned with investors. So in summary, cash is going up, debt's coming down, unutilised aircraft are going towards zero, airline insolvencies have been resolved, COVID's becoming endemic rather than a pandemic, we've got no Russian exposure, and look, and for those more sophisticated investors, we've got unsecured bonds out there. Those bonds are trading up 40 to 50% in the last year, and investors know that debt always leads equity in terms of increasing prices and optimism. So that's a great signal. So I'll just finish by saying, again, we are trading at 50% of our NAV per share. We've been around for 16 years, and this company pre-COVID always traded at NAV per share. Buy companies that are fundamentally undervalued, and that's what we think we are today. So thank you for your time. I'm still up there at the booth. If you need any of the information or if you want to talk to me about any of this stuff, thank you for your time.
Well, thank you very much, Richard. I've got one question for you, if I may, before you go.
Sure.
What is your, I mean, obviously you've been making this case, very persuasively your case. What does your share register look like, and has that, who are the people who are making the decision at the moment?
Yeah, well, look, and I see a couple of shareholders in the audience. One of the things that I'm quite happy to sort of, tell you about is that, pre-COVID, our market cap was over £200 million, and we had over 20% of our register owned by institutions. Now, because of the damage created by COVID, because of the damage to our market cap, institutions will sell out of your stock once your market cap goes below 100 million. And our market cap's around 60 or 70 million right now. So over the past year, when our share prices remained stagnant, even while people were being vaccinated, it's because those institutions, every time the share price hit £1.10, they'd sell it back to £1. £1.10, sell it back. Now they're all gone. They're all gone. Now, I thought that was really a reason for optimism. And then of course, Omicron came along in December. Everybody realised that, well, that's actually not that severe. And then Putin decides to invade. So look, we've had a lot of headwinds, but we can't focus on the share price. We've got to focus on fixing our problems, which I think we fixed, where the company's intact. We've still got $1 billion worth of stuff. We're going to generate $100 million of revenue this year. So it is time for some optimism.